What if I told you that almost every trader goes through the exact same journey? Not because they have the same personality, not because they trade the same market, but because the market exposes the same weaknesses in everyone. Some traders never make it past the first stage. Others spend years stuck in the middle, believing they're just one indicator away from consistency. And only a small percentage eventually understand what the market is actually communicating. The difference isn't intelligence, it isn't luck, and it certainly isn't finding a secret strategy. It's evolution. Today, we're going to break down the 5 stages every trader goes through, why most people get trapped before reaching the final stage, and how professional traders eventually learn to read what the market is really saying through price and volume. By the end of this video, you'll probably recognize exactly where you are in your own trading journey. Let's begin. Stage 1. The excitement stage. Everything looks easy. Almost every trader begins here. You discover the stock market. You see screenshots of huge profits on social media. Someone claims they turned a few $1,000s into 6 figures. You open a chart. Candlesticks look simple. Indicators promise accurate signals. Everything seems logical. You believe trading is mostly about predicting where price will go next. At this stage, volume barely matters. Price is everything. If price is going up, you buy. If price is falling, you sell. Simple. Or at least that's what it seems. Example, imagine Tesla breaks above yesterday's high. A beginner immediately buys because price is making new highs. What they never ask is, how many participants are actually supporting this move? Price alone tells you movement. Volume tells you participation. Ignoring participation is like judging a football game by the scoreboard without watching how the teams are actually playing. Eventually, the market teaches the first lesson. Price moves against them. Stage 2, indicator overload, searching for the perfect formula. After losing money, most traders don't question their understanding. Instead, they search for another indicator. Moving averages. MACD, RSI, stochastic, ADX, Bollinger Bands, Ichimoku, one after another. Charts slowly become crowded. Ironically, the more indicators added, the less clarity exists, because indicators only process price. They don't explain why price moved. Case study. Suppose the S&P 500 rallies for 3 consecutive days. Every momentum indicator looks bullish. Retail traders rush in, but volume declines every single day. Professionals immediately notice something different. Buying enthusiasm is fading. Price continues higher. Participation doesn't. Eventually, the rally fails. The indicator wasn't wrong. It simply couldn't tell the entire story. Because indicators measure movement. Volume measures conviction. Stage 3. Understanding price and volume. Together, the turning point. This is where serious traders begin separating themselves. They stop asking, where is price going? Instead, they ask, who is actually participating? Because every market move requires effort. Volume represents effort. Price represents result. Neither should ever be analyzed alone. Think about pushing a heavy car. If 10 people push, the car should move significantly. If it barely moves, something is resisting. Markets behave exactly the same way. Large buying volume should create meaningful upward movement. If it doesn't, something unusual is happening. Professionals immediately investigate. Retail traders usually don't even notice. The effort versus result principle. This concept comes directly from classical volume analysis. It's surprisingly simple. Large effort, small result, means resistance. Small effort, large result, means efficiency. Let's look at examples. Example 1, a stock trades nearly twice its normal daily volume, yet it closes almost exactly where it opened. Massive effort. Very little progress. Professional interpretation? Someone absorbed nearly all aggressive buying. Supply met demand. Distribution may be occurring. Example 2. Another stock rises 5% on average volume. Healthy candles. Steady buying. Little selling pressure. Moderate effort. Excellent result. This usually reflects genuine demand. Notice something important. Professionals aren't impressed by big candles. They're interested in how much effort was required to produce those candles. That's a completely different mindset. Stage 4. Learning major volume patterns. Once traders understand effort versus result, they begin recognizing recurring volume behavior. Let's examine 3 of the most important patterns. Pattern 1. Stopping volume. Imagine a market falling aggressively. Fear dominates headlines. Retail investors panic. Selling accelerates. Suddenly, an extremely high-volume candle appears. Price initially drops sharply, but buyers aggressively step in. The candle closes well above its lows. What happened? Professionals may have absorbed panic selling. Heavy volume appears. Selling pressure begins disappearing. This doesn't guarantee an immediate reversal, but it often signals exhaustion. Historical perspective. During many major bear market bottoms, the largest volume often appeared before the strongest recoveries because institutions were buying, while retail investors were desperately selling. Pattern 2. Buying climax. Now imagine the opposite. Markets have rallied for months. Financial news is overwhelmingly optimistic. Everyone expects higher prices. Volume suddenly explodes. Price makes new highs. But by the end of the day, the candle closes far below its intraday peak. Why? Because institutions may be selling into retail enthusiasm. Demand still exists, but supply has quietly become stronger. Professionals don't chase excitement. They often provide liquidity when everyone else becomes emotional. Buying climaxes frequently appear near important market tops. Not every top, but enough to deserve attention. Pattern 3. Volume divergence. Volume divergence occurs when price and participation stop agreeing. Example: price continues making higher highs. Volume steadily decreases. Momentum appears strong. Participation weakens. The trend hasn't reversed yet, but conviction is fading. Now consider the opposite. Price falls to new lows. Volume gradually increases. Demand quietly returns. Institutions may be accumulating while public sentiment remains negative. This divergence often appears before major trend changes. Again, not because volume predicts the future, but because it reveals changing participation. Stage 5. Thinking like a professional. Traders don't predict, they interpret. Every trading session asks 3 questions. Who participated? How much effort was required? Did price produce a logical result? Instead of searching for certainty, they search for evidence. Price gives evidence. Volume strengthens or weakens that evidence. Every chart becomes a conversation between buyers and sellers. Volume simply tells you how loud each side is speaking. Final thoughts. If you've recognized yourself in one of these stages, you're not alone. Every experienced trader has been there. The important question isn't how long you've traded. It's whether your understanding has evolved. Markets don't reward people who collect indicators. They reward people who understand behavior. Price tells you what happened. Volume tells you how much conviction was behind it. And when those 2 pieces of information are analyzed together, the market becomes significantly easier to interpret, not because it's predictable, but because it's understandable. So before your next trade, don't just ask where price is going, ask a better question. Is volume confirming the story that price is trying to tell? Because that single habit can completely change the way you read every chart you ever open. Thanks for watching, and I'll see you in the next video.